Friends, thank you for being here today. What if I told you that while the government celebrates a soft landing, over 11,000 Canadians filed for bankruptcy last month alone? What if the very metric they're using to declare victory, falling inflation, is masking a financial pandemic spreading faster than the economy can heal? We are witnessing something incomprehensible. In January 2026, Canadian insolvency filings spiked 20% month over month, not year over year, month over month. This is not a statistical blip. This is not seasonal noise. This is a structural fault line opening beneath the foundation of the entire consumer economy, and the edifice is beginning to crumble. Let me give you the scale of what we're discussing here. Canadian households are carrying $3.2 trillion in credit market debt. $3.2 trillion. To put that in perspective, that represents 176.7% of disposable income. For every single dollar a Canadian household earns, they owe $1.77 to the banks. This is not an economy. This is a mathematical endgame playing out in real time. And here's the metric that should terrify you. The insolvency rate has climbed to 4.2 per thousand adults. That's the highest rate since 2019, completely erasing every buffer, every cushion, every scrap of pandemic savings that households managed to accumulate. The tide is going out, friends, and we are about to find out who has been swimming naked. This is not a possibility. This is a mathematical certainty, a singular inevitability baked into the architecture of how this system was constructed. And to understand why this crisis was always coming, we need to go back to the Genesis moment, to the trap that was set 5 years ago. The year is 2020. The year is 2021. The world is in lockdown, and central banks have panicked. Variable mortgage rates drop below 2%. 5-year fixed rates drop below 2%. The Bank of Canada has essentially made borrowing free, and Canadians, rational actors responding to incentives, binged on cheap debt like it was the last meal before a famine. They bought homes. They upgraded homes. They took out lines of credit. They renovated. They spent. And they believed, because everyone told them to believe, that rates would stay low forever, that this was the new normal, that 2% was the floor, not the ceiling about to collapse. But here's what they didn't tell you. Here's what I call the big secret of the entire system. The bulk of these mortgages were 5-year terms, which means they all reset between 2025 and 2026. Right now, this is the maturity wall, and we have just slammed into it at full speed. Think of it like this. Imagine you took out a mortgage at 0% interest. You could afford a house worth 10 times your salary because the monthly payment was negligible. But here's the twist. It's not a 30-year mortgage at 0%. It's a 5-year teaser rate, and when it resets, you're paying 6%, 7%, maybe higher. Your payment doesn't go up 15%. It doubles, it triples, and the bank doesn't care that your salary hasn't changed. The contract resets and the bill comes due. That is what is happening to millions of Canadian households right now. 60% of all outstanding mortgages are renewing between 2025 and 2026. 60%. And the hit they are taking is catastrophic. Payments are jumping 15 to 20% for fixed rate holders. For variable rate holders, some are seeing increases of 40% or more. That is $320 to $500 per month pulled directly out of the grocery budget, the gas budget, the discretionary spending that keeps the economy alive. And this leads us to the system's most crucial secret, which we must explore now, because the government is lying to you by omission. They will show you charts. They will point to low bankruptcy rates. They will say, look, liquidations are manageable. The consumer is resilient. They are hiding the truth in the fine print in a mechanism called the consumer proposal. Here's the black box revelation. In Canada, there are two ways to file for insolvency. You can file for bankruptcy, which is liquidation. You lose your assets, the creditors divide what's left. Or you can file a consumer proposal, which is restructuring. You negotiate with creditors to pay cents on the dollar over a period of years. It's a shadow default, a bankruptcy in all but name. And here's the staggering reality. Consumer proposals now make up 79% of all insolvency filings. 79%. People are not losing their homes yet. They are becoming debt zombies, trapped in a state where they can service interest but never touch principal, negotiating to pay 30 cents, 40 cents, 50 cents on the dollar just to survive another month. The government celebrates this. They say, see, bankruptcy is low. The system is stable. They are lying. What they are witnessing is not stability. It is a slow motion implosion, a controlled demolition where the appearance of order masks total capital destruction beneath the surface. And there's another trap that's been hidden from you, a mechanism that banks deployed to delay the crisis, to kick the can down the road just a little bit further. It's called negative amortization. Here's how it worked. When rates started rising in 2022 and 2023, borrowers with variable rate mortgages suddenly couldn't afford the new payments. So the banks, in their infinite generosity, allowed them to pay less than the interest due. The difference, the gap between what you paid and what you actually owed, was added to your principal. Your mortgage balance grew every single month, even as you made payments. This bought time. It kept the insolvency numbers low. It allowed the government to declare victory, to talk about resilience and soft landings. But now at renewal, that option vanishes. The bill comes due all at once. You owe more than you borrowed, and the payment reset hits like a freight train. This is not a conspiracy. This is stated policy. This is the simple logic of compound interest applied to a population that was told rates would never rise again. And the consequences are unfolding exactly as the mathematics predicted. So we have established the foundation. We understand the trap that was set in 2020 and 2021. We understand the maturity wall that has arrived in 2025 and 2026. We understand the shadow default system hiding 79% of insolvencies from public view. Now we must examine the trigger event, the moment when the scaffolding began to snap in real time. January 2026, the insolvency data is released. Total filings are up 20% month over month compared to December 2025. 20% in a single month. This is not seasonal variation. Even year over year, total insolvencies are up approximately 10%, signaling a structural break in the consumer's ability to pay. But here's where it gets truly frightening, because the crisis is not spreading evenly. It is concentrating, metastasizing in specific sectors like a cancer, targeting the most vulnerable organs of the economy. Business insolvencies are not just rising, they are exploding in what I call the business kill zone. Construction, hospitality, accommodation, and food services, these sectors are seeing insolvency increases of 40% or more relative to previous baselines, 40%. These are not abstract industries on some distant balance sheet. These are the businesses that employ your neighbors. These are the restaurants where you eat, the contractors who build homes, the hotels that house travelers. And they are collapsing because of one simple, brutal fact. They rely on your discretionary spending. And your discretionary spending has evaporated. Why? Because you are trapped in the renewal shock. Your mortgage payment jumped $300, $400, $500 per month. That money had to come from somewhere. It came from eating out less. It came from canceling the renovation. It came from skipping the vacation. And when millions of households make that same calculation simultaneously, entire industries implode. This is the canary in the coal mine, friends. When construction companies cannot secure financing because banks see the housing market stalling, they file for insolvency. When restaurants cannot cover rent because foot traffic has collapsed, they shutter. And when they close, they lay off workers. And when those workers lose their jobs, they lose the income needed to service their own debt. The spiral accelerates, the contagion spreads. But there's a second canary singing an even darker song, and it involves a metric the mainstream media refuses to discuss: the debt service ratio. The Bank of Canada has cut rates. They started easing in late 2025. They are trying to provide relief to soften the blow. So why is the debt service ratio, the percentage of disposable income going to debt payments, still stuck near record highs at 14.6%? Why are rate cuts not translating into breathing room for households? The answer is as simple as it is devastating, because this is not an interest rate problem. This is a solvency problem. Principal repayments are increasing as interest-only periods end, as negative amortization arrangements terminate, as the bills that were deferred during the pandemic finally come due. You cannot cut your way out of a solvency crisis. Rate cuts do not fix a balance sheet where liabilities exceed assets. They merely delay the recognition of insolvency by a few months, maybe a year if you're lucky. And here's the evidence that the liquidity tide is draining faster than anyone anticipated. Credit card liabilities increased by $40.8 billion in the third quarter of 2025 alone. $40.8 billion. Households are not cutting back. They are shifting the debt from one pocket to another. From mortgages they can no longer afford to credit cards with 20% interest rates, trying desperately to maintain the appearance of normalcy. They are eating their equity. Your neighbors still drive new cars. They still eat out occasionally. They still take their kids to activities, but they are funding it with borrowed money, with lines of credit that are about to snap, with credit cards that are maxing out month after month. And when that line of credit is revoked, when the bank says no more, the lifestyle does not adjust gradually. It evaporates overnight. This is what I mean when I talk about the illusion versus the reality. The illusion is the new car in the driveway. The reality is the $40,000 line of credit that paid for it. The illusion is the renovated kitchen. The reality is the consumer proposal filed 6 months later when the homeowner realized they could not afford both the renovation loan and the mortgage renewal. The illusion is resilience. The reality is a population one missed paycheck away from insolvency. And now we must address the encirclement, the systematic dismantling of every escape route the average household thinks they have. You think you can ride this out in stocks? The liquidity that inflated equity markets is draining. When households are forced to sell their ETFs, their mutual funds, their retirement accounts to cover mortgage payments, who is the buyer? When businesses in the kill zone are liquidating assets to pay creditors, where does that capital go? It does not stay in risk assets. It flees to safety, to government bonds, to cash, creating a cascading sell-off that punishes the very people trying to preserve wealth. You think bonds are safe? Yields are spiking as governments are forced to issue more debt to cover the fiscal cost of this crisis. Unemployment insurance, bailouts, stimulus. When yields spike, bond prices collapse. Your safe haven becomes a trap. You think you can hold cash? Inflation may have fallen from its peak, but it has not vanished. It is eroding purchasing power every single day. The grocery bill keeps climbing. The utility bill keeps climbing. The insurance premium keeps climbing. Your cash buys less this year than it did last year, and it will buy even less next year. So, where do you go? What is the exit? This is the question I hear in every conversation, in every message, in every comment. And the answer requires us to understand the convergence, the trifecta of forces that are colliding simultaneously to create what I believe will be the defining economic event of this decade. Force number one, the mortgage cliff, peaking in mid 2026. We are not at the top yet. We are on the ascent. The bulk of renewals are still ahead of us, which means the insolvency spike we saw in January is not the peak. It is the leading edge of a wave that will crest sometime in the next 6 to 12 months. Force number two, insolvency acceleration. The 20% month-over-month jump is not an anomaly. It is the start of a trend line, the beginning of an exponential curve where each month's filings feed the next month's through job losses, business closures, and collapsing consumer confidence. Force number three, the unemployment tick. As businesses in the kill zone fold, as construction projects are canceled, as restaurants close permanently, jobs vanish. And when jobs vanish, the income needed to service debt disappears with them. Unemployment is a lagging indicator, but it is also a reinforcing one. The insolvency wave creates the unemployment wave, which amplifies the insolvency wave in a feedback loop that does not stop until the system purges the excess debt. This is the convergence, friends. This is the structural break, and it is already begun. Now, we must talk about something more dangerous than the financial mechanics. We must talk about your mind, because the greatest threat you face is not the insolvency wave or the mortgage cliff or even the convergence of forces we just outlined. The greatest threat is your own psychology, the cognitive trap that keeps you paralyzed while the system crumbles around you. It has a name: normalcy bias. Human beings are hardwired to believe that tomorrow will look like yesterday. We assume continuity. We assume that the patterns we have lived with for years, for decades, will persist indefinitely. When the data contradicts this assumption, when the evidence screams that something fundamental has changed, our brains reject it. We rationalize, we minimize, we wait for things to return to normal. But friends, there is no return. Normal died in 2020 when central banks flooded the system with free money and told an entire generation they could borrow without consequence. What you are living through now is not a deviation from normal. It is the restoration of mathematical reality after 5 years of monetary fiction. Your neighbors are experiencing this bias right now. They see the insolvency headlines, they hear about the mortgage renewals, but they think that won't happen to me. I'm different. I'll figure it out. And maybe they will. Maybe they are the statistical outlier with enough savings, enough income stability, enough financial cushion to absorb a 40% payment increase. But 79% of insolvency filers thought the same thing right up until the moment they walked into the trustee's office. This is the money illusion, the second psychological trap. You look at your investment account and see numbers that make you feel wealthy. Your home is worth $800,000 on paper. Your stock portfolio gained 15% last year. You are a millionaire in net worth. But you are poorer at the grocery store. You are poorer at the gas pump. You are poorer when the property tax bill arrives, when the insurance renewal comes due, when the mortgage resets. The number in your account is a claim on future purchasing power, not purchasing power itself. And when the system is forced to choose between preserving the nominal value of your assets and preserving their real value, it will choose nominal every single time. They will print to save the banks. They will print to backstop the mortgages. They will print to prevent a deflationary spiral. And in doing so, they will destroy the purchasing power of every dollar you think you own. This is not speculation. This is historical precedent playing out in real time across every fiat currency system that has ever existed. The end game is always the same: a reset, a repricing, a moment when the gap between paper wealth and real wealth becomes so vast that the illusion shatters all at once. And this brings us to the binary choice, the decision you must make right now while there is still time to act. Do you own assets or do you own claims on assets? Let me explain the difference because this is the linchpin of your financial survival. When you own a stock, you own a claim on a company's future earnings. When you own a bond, you own a claim on a government's future tax revenue. When you own a mutual fund or an ETF, you own a claim on a portfolio of claims. Every single one of these instruments depends on a counterparty fulfilling their obligation. The company must remain profitable. The government must remain solvent. The financial system must continue functioning. But when 79% of insolvency filers are restructuring their debt, paying cents on the dollar, what does that tell you about counterparty risk? When businesses in the kill zone are liquidating at 40% failure rates, what does that tell you about corporate earnings? When governments are issuing record amounts of debt to cover the fiscal cost of this crisis, what does that tell you about sovereign credit worthiness? You are a creditor to a system where the borrowers are defaulting in record numbers, and you are hoping, praying that you will be the exception, that your claims will be honored while everyone else's are restructured, diluted, or inflated away. The alternative is to step out of the counterparty chain entirely, to own assets that do not depend on someone else's promise to pay. Gold does not care if a Canadian consumer makes their mortgage payment. Silver does not care if a construction company files for bankruptcy. These are assets, not claims. They have value because of their physical properties, their scarcity, their 5,000-year history as a store of wealth outside the banking system. I am not saying this as investment advice. I am saying this as a matter of positioning yourself outside the line of fire. When the insolvency wave crests, when the mortgage cliff triggers a cascade of defaults, when the convergence of forces we discussed overwhelms the system's ability to respond, the flight to safety will not be orderly. It will be a stampede. And the people who wait until the crisis is obvious to everyone will find that the exit is already crowded, the premiums already spiked, the opportunity already gone. This is about preparation, not speculation. This is about recognizing that the architecture of the system has a fault line running through its foundation, and that fault line is widening every single month. Let me leave you with the forensic evidence, the data point that crystallizes everything we have discussed. In January 2026, actual filing data, not surveys, not forecasts, not models, showed a 20% month-over-month increase in insolvencies. This reflects immediate stress in household and business finances happening right now. The timing aligns perfectly with post-holiday cash strain and annual financial resets, the moment when deferred obligations surface and can no longer be hidden. The concentration in construction and hospitality, sectors that are interest sensitive and cash flow dependent, tells you that the pressure is building in the real economy, not just in abstract financial markets. These are the industries that employ millions. These are the businesses that anchor communities, and they are bearing disproportionate pressure because they are the first to feel the impact when consumer spending collapses. The dossier we have examined contrasts these insolvency figures with the soft landing narrative, the government's messaging that everything is under control, that inflation is falling, that resilience is the theme. But there is a gap, a chasm really, between aggregate economic messaging and on-the-ground financial outcomes. One of these is true. The other is a carefully constructed narrative designed to prevent panic. I will let you decide which is which. Friends, we are living through what I call the lag effect. Insolvencies are a lagging indicator. The rate hikes happened in 2022 and 2023. We are only now in 2026 feeling the full impact as mortgages reset, as interest-only periods end, as negative amortization arrangements terminate. The soft landing was just the calm, the eye of the storm, the brief moment of false stability before the credit cycle completes its reset. And here is the terrifying truth. We have not even seen the unemployment numbers tick up yet. When they do, when the job losses from business failures start showing up in the statistics, the insolvency acceleration will move from exponential to vertical, because unemployment removes the last variable holding the system together: income. Without income, there is no ability to service debt. Without the ability to service debt, there is only default, restructuring, or liquidation. The window for preparation is closing, not closed, but closing. History favors the prepared, and history is littered with the financial corpses of those who saw the warning signs, understood the mathematics, recognized the inevitability, and did nothing because normalcy bias convinced them that somehow this time would be different. It is never different. The mechanics change, the geography changes, the specific trigger changes, but the underlying dynamics, excessive debt, artificially suppressed interest rates, the inevitable reset when reality reasserts itself, these remain constant across every credit cycle in human history. You have been warned. The insolvency data is not a prediction. It is not a model. It is actual filing data showing a 20% month-over-month explosion in financial distress. The mortgage cliff is not a metaphor. It is 60% of outstanding mortgages resetting in a 12 to 18-month window. The business kill zone is not hyperbole. It is 40% plus failure rates in critical sectors of the economy. The convergence is here. The trifecta is forming. And the question is not whether the system will reset, but whether you will be positioned to survive the reset when it arrives. Do you own assets that exist outside the counterparty chain, or are you holding claims on a system where 79% of borrowers are filing proposals to not pay you back? The choice is yours, friends, but the mathematics is indifferent to your choice. The debt does not care if you believe in the soft landing. The insolvency wave does not pause because you are not ready. The structural fault line does not wait for permission to snap. It is already snapping. The sound you hear is not thunder in the distance. It is the foundation crumbling beneath your feet. History favors the prepared, and the window for preparation is closing. Thank you for being here today, friends. Thank you for listening. And please do not mistake this message for pessimism. This is realism. This is the mathematical endgame of a monetary experiment that began in 2020 and is now reaching its inevitable conclusion. Prepare accordingly.